Hello friends, welcome to the podcast. Today with us we have Mr. Ajit Kabi, who is a fundamental analyst at LKP Securities Ltd. Hi Ajit, as the net interest margin have picked, how do you see FY24 margins?
Hi Gaurav, thank you for having me here. And the question about the net interest margins for FY24. So in the fourth quarter of FY23, we have seen most of the banks have reported a spike in net interest margin because YOA, yields on advances were quite higher for this quarter. However, if going forward in FY24, we are seeing certain compression in net interest margin because there is no room for EBLR repricing, and the yields on advances will go slow, or we won't see much bigger surprise in yields on advances. However, there is the deposit competition among all the banks to raise their deposit and maintain a healthy liquidity coverage ratio. Therefore, we may see in this deposit competition, we may see the cost of deposit to go high, and bank may witness a little compression in their net interest margins. So we will see this across sector, and we have already seen in some of the cases like Federal Bank, the net interest margin compression was quite higher and quite significant, and it was quite sooner than expected. However, we can say that in case of Federal Bank, the net interest margin squeeze was sooner, and the stability in net interest margin for a Federal Bank will be sooner too. So it is not a major concern for Federal Bank, and we believe the FY24 net interest margins are going to be quite slower as compared to FY23. However, the profitability is going to be intact.
How the profitability will be impacted with margin compression?
The core profitability across banking sector is going to be stable as comparing to FY23. The net interest margins are going to be squeezed. The operating expenses are expected to be little higher because of lot of employee expenses and operating expenses in terms of tech-driven initiatives. However, the profitability of the banks, the return ratio, ROA and ROE are going to be stable because the NPA cycle is at the bottom, and we can say that credit cost of banks across sector won't be much higher. However, the recent ECL provisioning may impact few of the public sector banks by 1 or 1.1% of their entire loan book. However, they have few of the private sector banks have built a ample provision buffer, the non-specific provision buffer, which is excluding the PCR, and those buffers will be written back, and we won't see much credit cost impact in FY24. Therefore, we believe the return ratios are going to be stable or little improvement in major banks.
Tell us about your top picks in the sector.
For FY24, our investment theme will be loan growth and deposit growth simultaneously, with margin stability and lower credit cost. So factoring all those three things, we believe among large private sector banks, we are bullish on ICICI Bank, Axis Bank, and among the mid-sized banks, we are bullish on Federal Bank despite 8% rundown in last few weeks, and in smaller banks we are betting on CSB Bank because having a lot of growth capital and willingness to grow across portfolio, and we have seen the non-gold portfolio has improved significantly in fourth quarter, and affecting all those three things, we are bullish on these four banks. And among public sector banks, we are still bullish on Bank of Baroda. However, we see the valuation metrics are going to be stable, and we won't see much re-rating in valuation. It has rallied from 0.5 price to book. Now it is trading at around 1 price to book. So we are, despite all those things, we are bullish on Bank of Baroda and State Bank of India. Thank you.
Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing. The securities quoted are exemplary and are not recommended.